Japan's 30-year bond yield just hit a number that hasn't been seen since 1999. Their debt is now around $10 trillion, and the value of the yen against the US dollar is very close to its lowest level in decades. Even though Japan still has one of the biggest economies in the world, there are signs that something is wrong. This will have effects that go beyond Japan. They can spread to other markets around the world, including yours, even if you don't own any Japanese stocks. We're going to talk about what's really going on with the Japanese economy today, including why the yen has been falling so fast, why bond yields are suddenly going through the roof, and whether Japan can recover from what some economists are calling an early-stage national debt crisis. Please click the like button and join if you want to get news about money, the market, and business without all the extraneous stuff. Most people now think that Japan's money issues are old news. They've heard for years that Japan has a lot of debt, low interest rates, and an older population. It just sounds like background noise to them. This time, though, things are different. The story isn't just going over and over again, it's beginning to move faster. There's also a reason to care about Japan, even if it seems far away. Japan has more than $1 trillion in U.S. government bonds, which makes them one of the biggest foreign holders of U.S. debt. In other words, if Japan gets stressed and has to change how it handles its money, it will touch more than just Tokyo. It can change market prices and interest rates all over the world, including in the US. First, let's talk about Japan's huge debt. Japan has a huge government debt of about 10 trillion yen. Japan has one of the highest debt to GDP ratios among rich countries at around 260%, depending on the measure you use. In other words, Japan's government owes about 2.6 times what the whole economy makes in a year. When you have that much debt, you have to pay it back, which can be hard on your budget. Japan's debt servicing costs now take up about a quarter of its yearly budget. This includes interest and the cost of rolling over old debts. That's money that can't be used to help the economy, pay for schools, build roads, or pay for health care. The money goes back in time. Because Japan's interest rates were so low for years, this didn't seem to matter. It felt almost free to borrow money. It was like Japan had a huge credit card with no interest. The thing about deals with 0% APR is that they don't last forever. Japan's bond yields are going up, which is a big deal because when rates go up, so does the cost of paying off that $10 trillion debt. The math changes quickly once yields move. If you have that much debt, even a small change in the average cost of borrowing can make a big difference in how much interest you pay each year. The big question now is why yields are going up now after Japan had low rates for decades. Prices going up is part of the reason. A part of it is the rules. To add to that, Japan is learning what happens when the financial system has been artificially stable for a long time, and then the stability starts to fall apart. If you have US dollars, this is where things get really interesting. Let's talk about the yen. The value of the Japanese yen has been falling for a while now. At the time of this video, it's worth about 156 yen to $1 US, which is a level that hasn't been seen in decades. This isn't just a chance change either. It's a direct effect of the fact that American and Japanese monetary policies clashed. This is the easiest way to do it. The Bank of Japan kept rates very low for a long time, while the U.S. Federal Reserve raised rates sharply to fight inflation. This makes something called a difference in interest rates. As a trader, if you were to look at currencies as places to put your money, where would you set it? Earning interest on money in U.S. dollars that matters. Or in Japanese yen, getting almost nothing. The bigger yield is what most investors pick. That causes money to leave the yen and come into the dollar, which makes the yen weaker. A weak yen isn't always a bad thing. In some ways, it helps people who sell. Japanese goods can be more competitive on the world market if their currency is weaker, but this can be bad for Japan because it has to buy a lot of what it needs: food, energy, and raw materials. In yen terms, imported things cost more when the yen gets weaker. That makes prices go up in the United States. This puts the Bank of Japan in a tough spot. They could slow down the economy and make it more expensive to pay off debt if they raise rates to protect the yen and fight inflation. The yen stays weak and import prices stay high as long as rates stay low to protect the debt load and keep the economy from collapsing. That's the reason this matters. It's more than just a graph on a computer. It turns into a policy trap. Japan had a problem with deflation for many years. Prices aren't really going up or down. That's why Japan kept interest rates so low and pushed stimulus so hard. For many years, economists said that Japan needed inflation. Japan now has it. Compared to what Japanese families were used to, Japan's inflation rate has gone up a lot. And while it might not sound like a big deal compared to the US or Canada after the pandemic, it's a huge change for Japan because everyone's savings habits, wage hopes, and investment assumptions were based on the idea that inflation would stay low for a long time. You already know how this changes everything if you live in a place where inflation is normal. Using cash less and less makes sense. Savings accounts need to make money. People start to ask for pay raises. Companies start changing their prices. Also, the central bank can't act like there isn't inflation. The savers in Japan are a great model. It wasn't crazy to hold cash for years because prices weren't going up very much. There were also not as many high-return savings accounts in Japan as there are in the United States because interest rates were so low. A lot of money was sitting in forms that looked like cash, but inflation changes all of that. Cash melts like an ice cube when inflation is high. That makes people want to get their money back. It changes how people buy things. It puts stress on the central bank to act. Now we get to the story's most important part, reasons for the rise in Japanese bond prices. This is where you need to pay attention to quantitative easing. And even more importantly, what happens when quantitative easing stops or turns around? Japan had one of the strictest quantitative easing schemes in modern history for many years. Here it is in simple English. The Japanese government spends more than it brings in, so it issues government bonds to borrow money. Most of the time, buyers buy those bonds. But if there isn't enough demand, the government has to raise rates to get people to buy. That means it costs more to borrow money. That wasn't what Japan wanted. Instead of letting the market decide how much the government could borrow, the Bank of Japan stepped in and bought a lot of it. They made new money and bought Japanese government bonds with it. This caused bond prices to rise and yields to fall. In a way, they became the last-ditch buyer. And in the end, almost the only buyer. Over time, the Bank of Japan bought a huge number of Japanese government bonds, or JGBs. The Bank of Japan used to own more than half of all government bonds on the market. That means the Bank of Japan wasn't just a part of the market, they were IT. But this is what changed. As inflation got worse, the Bank of Japan couldn't keep growing its balance sheet in the same way, or it would have caused more inflation and a weaker currency. That's why they began to move back. They quit buying bonds as quickly. After that, the subject of lowering the balance sheet came up. So think about what that means in a practical sense. What will happen to prices if the biggest buyer in a market stops buying or starts selling? Bond prices go down, and rates go up when bond prices go down. That's the exact thing you see. The rise in yields isn't just because Japan is now riskier. It's also the bond market adjusting to the fact that the central bank can't always buy bonds. Now, let's talk about something else that doesn't get much attention in Western media, but is real in the real world. Travel, specifically tourists from mainland China. Japan's tourism boom has been very good for the economy. And Chinese tourists have always been one of the biggest groups of tourists who spend a lot of money in Japan. But there is something important in the text. Reports say that travel from mainland China has dropped sharply, and it's no longer because of the effects of the pandemic. It has to do with politics. Tense times in world politics can make tourism useful. Fewer people come if they are not encouraged to travel. When tourists leave, they don't bring as many shopping bags, book as many hotels and restaurants, and spend less at thousands of small companies. And unlike a stock market crash, signs of weak tourism don't always show up right away in the numbers. It first shows up in normal life. Hotels with lower prices, fewer tour buses, quieter high-end shopping areas, and slower foot traffic. That's important because Japan is already dealing with a weak economy, rising yields, and a shrinking population. When shocks hit areas that deal with consumers, like tourism, the economy has less room to handle those big picture pressures. Now we can talk about the thing that makes everything else possible. How Japan's people live. Japan had about 128 million people at its peak in 2010. It's now closer to 125 million, and it's still going down. Japan's population could drop below 100 million by 2050, which would be a huge drop in just a few decades. Japan has a high median age of 49, and more people over 65 than under 15 live there. In other words, fewer people are working and more people are retiring. What does this have to do with money? Because fewer workers mean less work gets done, less tax money comes in, and healthcare and benefits are put under more stress. And over time, it gets harder to pay off huge amounts of debt when your tax base is shrinking. Demographics make it harder to grow your way out of a crisis, even if Japan avoids a big one. That's why things in Japan can feel like they're moving slowly. Even though the country is rich, stable, technologically advanced, and highly educated, it faces a lot of structural problems. The next thing everyone wants to know is, will Japan get better? And the honest answer is that it depends on what you mean by grow back. It's not likely that we'll go back to the fast rise and dominance of the 1980s. That's the most likely thing that will happen. Japan can keep its security and high quality of life while dealing with debt and population growth. There are 4 situations in the transcript, which is a good way to think about it. Scenario 1, take care of decline. Japan doesn't mind slower growth as long as it means security and careful management of debt while keeping the quality of life high. This is the most likely result. Japan is still rich, safe, and innovative. It's just not growing very quickly. Option 2, changes to immigration laws. Japan makes it easier for people to move there to help stop the population loss. Large-scale immigration, on the other hand, would be a big change for Japan's culture and government. There have been some steps taken, but not enough to change the direction of things. Scenario 3, a change in technology. Japan uses AI and robots to make up for a shrinking workforce. Japan would be one of the best places to do it if anyone could. They are already the best at robotics, and automation could help them keep up their output with fewer people. But it doesn't happen right away, and it doesn't completely replace demographics overnight. Scenario 4, a debt problem and a fresh start. How things turned out badly. Debt gets too big to handle, which leads to reorganization, currency failure, and a system reset. There is a good chance that Japan won't have to do this because a lot of its debt is owned by Japanese citizens, and the country still has strong institutions. But now that yields are going up, this situation seems more likely than it did when yields were close to 0. It's most likely that the road will be somewhere between 1 and 3. Japan is able to handle slow growth, make small steps forward on immigration and technology, and reach stability without a major reset. But here's what makes them different. Recovery is not the same as managing a drop. Japan most likely won't fall apart. It still has one of the biggest economies in the world, with stable societies, world-class businesses, and advanced industry. Japan isn't likely to return to the time of high growth anytime soon, though. Now, it doesn't matter if you're not Japanese, because what's happening in Japan affects markets around the world and your interests. First, Japan's huge treasury assets are important. If Japan ever needs to sell U.S. bonds to get its own finances back on track, that could make U.S. yields go up. And everything changes when U.S. yields go up. Mortgage rates, the cost of getting money for businesses, and stock prices. Second, a weak yen changes how competition works. Japanese exports are getting stronger, which puts pressure on manufacturers in the US and Europe. Changes in currencies can affect prices, trade flows, and profit margins. Third, Japan shows other countries what not to do. Japan is pretty much on the cutting edge of population loss. China, South Korea, and finally some parts of Europe will have the same problems. Knowing about Japan can help you guess how debt, population, and central bank strategy will affect each other. Also, fourth, yes, chances can come up. When the yen is weak, Japanese assets cost less for buyers from other countries. When the value of some Japanese companies goes down, they become more appealing. Also, it was already said that Warren Buffett has put money into Japanese trade companies. That doesn't mean everyone needs to buy Japan right away, but it does mean that Japan can go from being dull to being interesting as a business destination when the value of the currency and the way it is valued change